Welcome to the Personal Pension Radio Podcast, where you get unconventional insights into wealth building and retirement that actually work. Discover data-driven strategies and learn from a wealth of experience so that you can take your retirement to the next level. Now, here's your host. He was once bitten by a harbor seal, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Glad you are still with me. Really appreciate all the support, the downloads consistently. Just humble me. I really appreciate all of the support from all around the country, and even those folks. Hello, everybody in the Philippines. Hello, those folks in Europe, London. There's Australia. We've got downloads all over the world, and it's just fantastic how small the world is nowadays, and really appreciate you spending some time with me while you're running on the treadmill, riding your bike, fleeing from a dog chasing you in the morning. Who knows what you're doing? Glad you're here. We are broadcasting live from Mr. Foley's van today, parked outside the community center in Franklin, Tennessee. There's some significance to that. Let's just say we're parked outside. We'll keep our eyes out. Now, we are brought to you by personalpensionradio.com. If you haven't been to the website, back podcast episodes. This is episode number 60. We are 60 episodes old. That's amazing. We should have a party, balloons, something. I don't know. I think we'll just crank along and maybe have a big party at podcast episode 100. How about that? We'll do a podcast episode 100. Big deal. But for now, let's get into it. What is Personal Pension Radio all about? For those of you who are new to the show, Personal Pension Radio is all about the forgotten conversation. I'm going to call it that today because so often it is not part of the retirement planning conversation, and that is retirement income. Retirement income does not happen with a product like a 401k or life insurance or real estate or stocks, bonds. It doesn't happen with a product. Retirement income maximization only happens when you put all of those things together into an actual integrated retirement strategy. So that's the key. Personal Pension Radio is all about bringing you the information, the conversation that you need to ask the right questions, to have the right perspective on your retirement planning journey. And remember that. It is a journey. It is a continuous journey. We have the accumulation phase, where we are heading up the mountain. We are saving for retirement. We're building 401ks, investing in real estate, building a business. Whatever it might be, you are accumulating wealth. That's the goal. The part that's missing in the conversation in the financial world is the downhill journey. It is one continuous journey, and I call it the distribution phase. The distribution phase of the journey is part of that same trip, but it has a very different set of rules. Very different set of rules for the downhill or the distribution side. So Personal Pension Radio is all about bringing you the information, the conversation necessary for you to be aware, number one, that there are two different sides of that one continuous journey, and to be able to stop and ask the right questions, to challenge conventional wisdom. So before I jump in, just a short disclosure to protect you and protect me. I am not an attorney. I'm not a CPA. I don't play either of those on TV. I don't play them here. I am a certified financial planner professional. Please don't act on things that you hear on this show. Things that you hear on this show are informational in nature, somewhat educational, but until you have a meeting with a qualified financial advisor, a licensed qualified financial advisor, and I say that specifically because financial entertainers on the radio and on TV, they are usually not licensed. And if they are licensed, they're not going to be able to spend enough time with you to give good advice. So before you take and act on anything you hear on this show or any other show, make sure that you meet with a qualified financial advisor. A number of you in the audience have actually contacted me through personalpensionradio.com. go for it. Do that. It's a great way to get a free consultation with a certified financial planner. It's an excellent opportunity. I'd love to hear from you. So let's jump in to the first segment. Watch Your Step is my first segment. And I really want to keep up with this tax theme. I've had a lot of conversations lately on taxes and things like that. Now, you heard me just say a moment ago, I'm not a CPA, so I'm not here giving you any kind of personal tax advice, but a question came up recently in a presentation that I did. I do a number of presentations on retirement income planning, and a question came up as it was related to taxes. And I guess it's just, once again, this particular question just reaffirmed in my mind that it is everywhere. The message that we've been fed over the last 30 or 40 years is save money on taxes, get a 401k, do this, do that, all of the same things you've heard me talk about on this show. But this individual was asking a tax code question, or let me not say that. He was asking a tax-related question that was really answered by the tax code. You don't have to be a CPA to know that there are certain parts of the tax code that might be useful for him. A good certified financial planner or financial advisor will be aware of these things and can direct you in that way. However, it made me think about something that I'd heard before, and maybe something that I'd said personally, but something that I'd heard before, and it is this. The tax code, the great big book of or Bible of taxes and all the various tax information. Someone said once that it's 600 million words and counting. The tax code is crazy big. But they said this, the tax code is really just a playbook. You think about football or basketball or baseball, the team has a playbook that has the rules and all of the various different plays that are in that book. Well, the tax code is just a great big playbook. And here's the thing. The wealthy and the rich do not have some different playbook. They don't have a different book that they get to access some super secret tax code. It's all the same tax code. The difference is they consult, the rich and the wealthy often will consult with qualified financial professionals who know how to read the book. That's the difference. There's no super secret tax code book for the wealthy to pay less tax than average folks. Just isn't there. It's the same book. So my answer to this gentleman who had asked a question in my presentation was, you just need to find someone else to help you read the playbook, because apparently his advisors did not know which sections of the tax code that he should be bringing into his strategy. And so basically he was just going along and paying taxes like every average person kind of thing, instead of taking advantage of some tremendous tax benefits that he could easily take and qualify for. He just wasn't thinking that that was something that was available to him. He thought that was just something that was there for the rich. That is not at all the case. So remember, the tax code is a big playbook. The rich and the wealthy, they don't have some special playbook. They have the exact same one. You just have to have the right financial advisory relationships to help you get that sections that you need for yourself. Now, finally, on the Watch Your Step, as we're speaking of taxes, someone asked me recently whether they should max out their IRAs and SEP, Simplified Employee Pension IRAs. And my question was back to them, well, what is your current tax bracket given that you have children and you have a mortgage and so forth? And no one had ever stopped to ask that. And then I asked, well, who is suggesting that you max out your IRAs and max out your 401ks? Where did that advice come from? Well, sure enough, the advice came from their accountant. Their accountant at one of the those places that pop up every year. They start getting real big. Well, let's just not say they're on the block somewhere. How's that? We'll say that. So the accountant had said, you might want to max out your IRAs or 401ks so you can lower your taxable income. Well, my question came from a different perspective was, well, what is your tax bracket today compared to what it might be in the future? And my friend, this person, who had asked me, said, well, I guess I hadn't really thought about that. And then my next question was, do you think you will have kids at home where you'll have a tax deduction for children when you retire? No, of course, probably not. We hope the kids won't be home. Then will you have a mortgage? Do you plan on having a mortgage in retirement? Well, the answer was no. I'd really hope I don't. So what they were saying is that, number one, they don't plan on having any kids at home where they have a tax deduction. Those are legitimate tax deductions. When you have kids and you're writing them off on your taxes, the government doesn't come back and recapture that tax money. That's a legitimate tax deduction. When you have a mortgage interest deduction, that's a legitimate tax deduction. They don't come back and recapture the interest on your primary home someday. They don't do that. Now, on the other hand, if you put money into a 401k or an IRA, that's a tax postponement. So remember, it's a tax postponement into a future point in time when you don't know what the tax rate will be or what your taxable income will be. So my advice to these folks was really to go back and run a calculation to find out what really would their net tax be if they just saved the money somewhere else. Maybe they didn't put it in an IRA or a 401k, as the accountant had suggested. So that again, not to say that 401k or IRA are bad things. Not at all. They are great accumulation vehicles. However, they are tax postponed. Deferred taxes means that someday those taxes need to be paid. And if you end up in retirement with taxable Social Security, taxable 401k and IRA distributions, possibly taxable investment income, well, who's to say that the government hasn't changed the tax rates by then? So you've got to ask the question, what net impact does it have today? And you might find out that today, with children and mortgages and possibly business deductions, you might actually be in a fairly low marginal tax bracket that is unlikely to happen when you're in retirement. So keep that in mind as we're in tax time right now, coming up. As I'm recording this, tax time is coming up in a month or two here, just about a month and a half. So keep that in mind. Now, the next section is listener and client questions. This is actually a section that I've done now and then, but I wanted to bring this back because we've had some really great questions come in, and I want to make sure that if you've got questions, go to Personal Pension Radio and just contact me there on the website. That's the best way to get me. You can also sign up for the podcast at iTunes, of course, but sign up for our mailing list and sign up there on Personal Pension Radio so you can get the updates. Now, first question. I'm just going to jump right into this one because this is a big one that I've heard many times. And this happened after a conversation with someone who was introduced to me as a prospective new client from a client. So the question was, why haven't I heard this stuff before? So I went through a conversation where we talked about retirement income planning and up the mountain with accumulation and down the mountain with distribution and all of these various rules that are applied to either side, but they don't translate from one side to the other. What I was talking about is things like when we were accumulating wealth, we hear phrases like average rate of return, where our 10-year average rate of return is X, right? And we get ups and downs for 10 years. We add and subtract, and we divide by 10, and that gives us an average rate of return. Now, here's the thing to remind you of, is that average rate of return is an accumulation term. And it only works because we're not doing one thing. We're not taking any money out. So if we're not distributing money out of the account, we can do average rate of return all the time. That's fine. It's still not an accurate assessment of what a long-term rate of return is, but average rate of return works. Now, take that to the distribution side. So the distribution side of your journey in retirement is now we're pulling money out of the account. Now we can't use average rate of return anymore. Now we're concerned in a distribution environment, we're concerned about sequence risk. The year-by-year sequence of returns has everything to do with how long your retirement income strategy might work. So the question was, why haven't they heard this before? That was it. It was just, I've heard it many times. So here's my answer. And actually what I do now when I speak on this topic, I actually will bring these three publications. I'll bring three publications with me to the event, or I usually will have them in my office, where I will have Financial Planning Magazine. Financial Planning Magazine is the magazine that certified financial planning professionals like myself, we receive that magazine as a CFP. Investment News is a periodical that comes out, and that's exactly what it is, Investment News, and it's primarily directed towards the financial advisory community. And I'll also have usually one or two other types of magazines that I'll reference. So it'll be another financial publication like Advisor Today, something like that is directed towards the financial community. And I'll use these 2 or 3 magazines or publications as my example to answer the question, why haven't we heard this kind of stuff before? Well, when you go through Financial Planning Magazine, for example, on average, I think I've counted the first 9 pages, including the inside front cover. It takes 9 pages turning and turning before you get to the first actual article or content. Those 9 pages are filled with advertisements from investment companies, investment-related companies, basically Wall Street advertising, Wall Street financial advertising. You go into Investment News. The advertising is dominated by investment advisory firms, investment companies, mutual funds, annuities, you name it. It's just dominated by it. What I'm trying to say is probably best summed up with this question. Okay, the answer to the question, why haven't we heard this before, I find is best answered with this question. Does the financial world, the investment community, have any financial incentive to teach you how to take your money out of the system? Let me say that again. Does the financial world, the Wall Street world, do they have any financial incentive to spend millions of dollars on advertising teaching you and I how to take money out of their system? Well, I would argue the answer is no. They don't have any financial incentive to spend any money teaching you how to take it out. They spend all of their money, for the most part, on encouraging you to put more and more and more money in, right? So that's my answer. That it's not insidious, it's not evil, it's not that, Wall Street's bad. It's just makes business sense. There's no sense spending money teaching people to do something that is financially damaging for your end goal. So that's why that's why I started Personal Pension Radio. That's why I'm here on this podcast. That's why I'm out there talking to as many people as I can to teach them the things that I, as a financial advisor, was never taught. The information that I am fed and that I was consuming as a financial advisor was exactly what the financial community wanted me to learn and then wanted me to share with you. So thankfully, I've continued to grow in my practice over the last 18 plus years so that I am now in a position where I'm trying my best to get to the top of the mountain, to yell out to everybody, ask questions, challenge that conventional wisdom. Okay, the next one. This is a big question. This question was, how do I know when I can retire? How do I know when I can retire? Wow, that is a huge question. So I'm going to take my specialty, income planning, and I'm going to answer the question this way. find out what your income number is. Find out what your income number is. The whole financial world wants to tell you, you've got to get your number. What's your number? How big's your 401k? The size of your investment account is the answer to retirement. And that's wrong. That is not correct. Retirement income is not based on the sum total of an investment account portfolio. It is the sum total of how your investments, your life insurance, your business assets, your guaranteed assets, all of those things have to be balanced properly for you to be able to get to that retirement income number. So how do you know when you can retire? Well, the answer is, if your retirement income number can actually sustain your desired lifestyle. It is not how big your 401k is by itself. It is when you reach the point that you have balanced your retirement assets, your actuarial assets, when you've balanced those types of things correctly, and you're able to get a retirement income number that sustains your lifestyle consistently and with a high probability, low risk, high probability of success, then you can retire, right? So the answer to when I can retire, I would argue, is not in a 401k statement balance. It is in the retirement income number that you can expect to comfortably receive when you get to retirement. So if you don't know yet what your current retirement income number is, I would suggest you go to Personal Pension Radio, get in touch, ask for the retirement income analysis. It's a very simple process, just a few questions to ask. We can take care of it over the phone even, and I will generate, as I've done for many of you, I will go ahead and generate your retirement income comparison report so you can see what you're currently on track for and you can see what your options are. Great question there. Thank you for that. Now, next question. I'm 45 years old with a wife and 2 kids and a mortgage. The all-American family. Should I buy long-term care insurance? So I asked, why this question? Where did this question come from? Well, a financial advisor was suggesting that they buy long-term care insurance. Now, I'm a huge fan of long-term care insurance. I really am. Now, my question, though, was, how well protected is this family before we're going down the road of long-term care insurance? So long-term care insurance, for those of you who don't know, comes in right now a couple of different flavors, if you will. You can get long-term care insurance that you pay for monthly, annually, that if you get sick or have a stroke or a long-term chronic illness, the long-term care insurance will reimburse or pay for nursing home care, things like that. Now, the standard, the long-term care insurance that most were familiar with over the years is that monthly pay-as-you-go, kind of like a car insurance or home insurance. And if you don't use it, you lose it. Now, there's also long-term care insurance that is based on a life insurance chassis. So, if you don't use it, well, the life insurance benefit goes to your family. So, the money is never lost. Money that is spent on long-term care insurance that is based on life insurance, that money is never lost because at least the death benefit pays to the family. But if you have a stroke or get sick, that death benefit will come out in the form of long-term care reimbursement. Okay, so back to the question. Should I buy long-term care insurance? Well, at 45 and a wife and 2 kids and a mortgage, my question went back to, how well protected is this family? Do they have their car insurance right, their home insurance right? Do they have their life insurance right? Just good old basic, questions like that. And the funny thing was, when I asked those questions like car insurance, home insurance, life insurance, the response I got back was, well, the other advisor didn't even mention that. He had sold us some, and turns out had sold them some basic term life insurance a while back when they had their first child, and now is coming back suggesting long-term care insurance. Well, I dug a little deeper, and as it turns out, now with 2 kids and him actually working as the primary income earner and a mortgage, they were dramatically underinsured just on their life insurance. And they didn't even have, for example, an umbrella liability policy on their car and home. The family was just simply unprotected in the most basic way. So the idea of getting long-term care insurance for a pretty unlikely event, now granted, I'm going to give you an idea. Now, long-term care insurance is very important, but I'm going to tell you what I suggested in this case for these folks who asked the question. So go back to the basic protection: 45, wife, 2 kids, and a mortgage. So their life insurance was dramatically too low. So my recommendation was, after fixing their car insurance, getting them set with umbrella liability insurance to protect them as they're driving around out there, was to now visit their life insurance and make sure that they had enough life insurance to replace his income for at least 10 to 15 years of his income. I mean, think about it. With 2 young kids and a wife at home who's not working, how easy is it going to be for her to go and get a job and still be able to raise 2 kids the way that she always hoped to raise them? It's impossible. So the life insurance is not there to pay off a mortgage. The life insurance would be there first and foremost to replace his paycheck. Now, here's the long-term care tie-in. The long-term care tie-in is this: that if you get your basic life insurance from the right company, that company can offer conversion options. So my life insurance company, if you ever want to know anything about it, and this specifically, make sure you just get to Personal Pension Radio and ask me, because if you've never heard this before, this stuff is fantastic. My opinion, I love my life insurance because of the security that it gives me and my family. So what I suggested for this gentleman is get additional term life insurance. Protection first. And if you get it from the right company, the company that I use personally, that company offers a conversion feature that says if, and I'm going to use me as an example, if I had a stroke today and I wasn't able to work anymore, so I'm a stroke victim and I'm incapacitated, now a long-term care patient, right? I actually have the ability to take my basic term insurance, which really doesn't cost any more than regular term insurance from any other company, and I can take my basic term insurance and convert it to a long-term care insurance policy with no medical exams, no additional processes or anything, just simple convert my term to long-term care insurance, and the insurance company will start paying for my care while I'm alive with tax-free dollars. That's powerful protection just by making sure the term insurance is right. So if you have not had your term life insurance checked recently, that is a big reason to get to Personal Pension Radio and get in touch with me. I'm happy to give you a comparison. There's very few companies that offer this kind of convertibility. Only one that I know of that offers the type that I have. So please, if you haven't had it checked, get to Personal Pension Radio now. I would be happy to take a look and give you some information. So the answer to this particular person's question was, no, you shouldn't go buy long-term care insurance until you have properly protected the castle. Got to make sure that the insurances like car and home and liability and life insurance are right first. And in this case, we're able to fix the life insurance and add this long-term care insurance component. Now, finally, this is a listener question. I took a class at church This person says, and they said that I should pay cash for everything instead of using credit cards. Is that a good idea? Well, that depends on you. That depends on you and your ability to manage and maintain your cash flow and your debt. So I will tell you that 20 years ago, I could not be trusted with credit cards, and I blew up all kinds of balances and ended up with several thousands of dollars in debt on credit cards at 20% interest. Now, fast forward today, I have a consistent habit for years of using credit cards for everything. I use credit cards for everything because I get airline miles on one primary credit card that we use all the time for Southwest Airlines, and we get airline miles for everything we buy on our credit card. Now, we do not carry a balance from month to month. I track and record our spending on my Quicken software. I use accounting software, and I track it. So I have gotten into the habit of using a credit card for literally everything, and my wife and I have flown all over the country for free and saved a ton of money on airline flights because of the way we manage our credit card bill, our credit card and use of credit cards. Let me say that. Let me get my tongue untied. Because of the way my wife and I use our credit cards, aka responsibly, we have been able to enjoy thousands of dollars of airfare all over the country as part of that process. So if you are in the habit of being able to monitor and keep track of and pay off that credit card every month, I say yes, use the heck out of those credit cards. I don't care what Dave Ramsey says. If you have the ability to follow a system, a process, a habit of paying those credit cards off and not spending foolishly, then use those credit cards like crazy. If you are not yet what you would call yourself responsible with money, then heck no. Don't use debt or credit cards or anything like that, because if you're not in a position where you feel confident in yourself that you're going to stay away from using those things and letting them get out of control, don't do it. Don't take on debt of any kind, really, if that's not your personality. But here's what I think. Again, my opinion. I think if you take some time and actually build yourself a habit around how to use debt wisely, well, debt is an extremely powerful tool in building wealth if you know how to use it and to leverage it properly. Okay, so the answer to the question, should I pay cash for everything instead of using credit cards? My answer, if you're a responsible person and you can maintain that system, heck no. Use the credit cards for everything. Find a good credit card that gives you airline miles on an airline that you like. My wife and I love to fly Southwest. They're fun. They're inexpensive, and the miles take us a long way. Let's put it that way. So use that kind of a card that gives you some sort of a perk or a benefit. Okay, so that would be my suggestion. Now, let's finish up with a couple of client stories. And I couldn't resist this one because, again, this is a tax time theme today. I'm smiling on this one because this happens all too often. And I want to qualify this by saying to all of the CPAs and accountants who might be listening, I don't mean to step on toes, but I have to bring this up for the listening audience because I've said it before. I want you to ask questions. I encourage you to challenge conventional wisdom. I want you to don't be afraid to say, well, wait a minute, who said that's the way it's supposed to be done? So this first client story, this is actually a client that a while back several years ago, had actually said, I'd like to start a 401k. Now, I had just recently been introduced to this client back then, a couple of years ago, by a business associate. Now, when I first met this person in their business, the first question was, my CPA says we should start a 401k. Well, I asked why. Oh, for tax savings. Okay, so we went through what you heard me go through before, so I won't rehash that. But suffice it to say this. I went back through protection first, then liquidity, cash flow, then savings and investment, right? That's my process. It's very basic. It's like building a house. Protect the castle first. Car insurance, home insurance, business insurance, life insurance, disability insurance, all of those things to protect the castle first. Then cash on hand, liquidity for opportunities and emergencies. Then we start investing into illiquid places like 401ks. They're not very liquid. You really just can't jump in and out of them without penalties and things like that. So 401k is not in the first steps when I work with a client. So I had encouraged this business person to hold off on the 401k. Let's get these other things in line first. And we did. And sure enough, now this year, we've got the 401k ready to go on the table. And we sat down to review with this person. This is a human resources company. We'll say that. Remember, names are changed to protect me. So we sat down and we discussed and started to go through the idea of the 401k. And that's when my client said, oh, I also started, and now it gets good. I also started another retirement plan for myself with an investment company. Oh, my question was, okay, who gave you the advice to do that? Oh, my accountant. Wait a minute. So this is that your accountant gave you the advice to start another retirement plan outside of your company? Yes. Okay. Does your accountant know that you were also going to be starting a 401k? Yes. Wow. Here's where you got to watch out. You cannot have an outside retirement plan separated from your 401k plan. You can't do that. If you're a business owner, you can't just simply go out and start another tax-deferred retirement plan when you set up a 401k plan. That could create some serious penalty issues if you're listening to this and you've got some sort of a tax-deductible retirement plan outside in some other little business somewhere else, and you own that other business, and you have a 401k in another business, that can cause you some serious problems with tax code violations. So thankfully, I was able to ask the right questions and was able to then give the proper caution to say, whoa, you've got to go back, talk to your accountant, because that is bad business. That's not a good thing. So my client was able to get that other plan canceled, closed down, and now is the proud parent of a brand new bouncing baby 401k plan. So the 401k plan is now getting installed. It's the right timing. It's much better than just throwing it on the table 2 years ago. It just wasn't the right place to be. So that's a great thing. Now, the next one here is a vice president of a local company actually had come to me, again, through an introduction. Someone had introduced her to me, and we went through and just sat down for our initial discovery meeting just over a year ago. It's about a year and change ago. And this lady is just as busy as anybody can be. I tell you, she is just crazy, crazy busy. So it's been so difficult for us just to find the time to have these conversations to move our discussions forward. But here's what happened. When we first met, I asked questions around protection first. You've gotten to know me. If you've listened to this podcast, I am a protection first financial planner. I want to make sure that my clients are properly protected. Then we start building only from a safe position, right? So when I went through this discussion, I started asking about car insurance and home insurance, and this lady's voice changed, her eyes changed, everything changed. And I said, "What's going on?" She says, "Oh my gosh, I wish I had talked to you just 2 weeks ago." Well, what happened? Well, I was in a car accident on the freeway. There was some rainwater and just things were slippery. And all of a sudden I'm sliding into the back end of this car. And we had a pretty good accident on the freeway. Oh, wow. That's unfortunate. Were you okay? Yeah, I'm all right. My neck was sore. How about the other driver? Were they okay? Yeah, she was fine. At least she said she was fine. And I said, "Oh, please tell me that you had umbrella liability insurance." And she said, "Oh, no, we don't. All we have is our regular insurance, which turned out to be a $300,000 policy." So a $300,000 liability limit on their car insurance. Okay. Now, that was the end of the story. At that point, the insurance companies were talking to each other and so forth. Well, reconnecting with my friend and my client here this year, so a little over a year later, she received a phone call that she's being sued. A civil case, being sued by the man that she had hit on the rainy day over a year ago. Okay? The man and woman in the car now suing her. And at the time the two of them said they were fine, right? The driver, the guy or the lady, I forget who it was, driving, said they're fine. But now the two of them, over a year later, she's being sued and doesn't exactly know how big the case is going to be. So she and I met too late for me to give that advice to say, get your car insurance and home insurance done right. Oh my gosh. But here's the advice I would give. And I did give to my friend, my client here, like, now that this has happened, don't just rely on your car insurance attorneys. This is a time for her and her family to go get their own attorney to consult on this case. They don't necessarily have to have a full-time attorney, but they need to go get a personal injury attorney or somebody to consult on their case to make sure that their insurance company is doing everything that they can. So I share that as a cautionary tale. I've talked about it before on this podcast. The whole financial world is out there yelling about from their top of the mountain, because they've got all the money to spend on marketing, that retirement is all about your number. It's all about save, get your 401k, get a tax deduction, et cetera, et cetera. So few financial advisors are stopping to say, "Hey, how's your car insurance? Do you have your car insurance right?" Because let me ask, what do you think is going to happen if this person has a civil judgment against them? How is that going to impact their retirement or ability to save for retirement, right? It's going to be huge. So retirement planning is not a product. It is not a 401k. It is not life insurance. It is everything together, a coordinated effort, meaning right from the beginning, your car insurance, home insurance, life insurance, 401ks, IRAs, stocks, bonds, all of those things have to be right, because one of those things, in this case, car insurance, could completely derail you for an unknown period of time. So be safe. If you haven't had your car insurance and home insurance reviewed by someone like me, a financial planning professional, then send it to me. Get in touch with me on personalpensionradio.com. I'm happy to review your personal protection. I'll give you my comments, my insight. You can take that back to whoever you like. I want you to be safe. I want you to be protected right. So there's my offer for that. Now, keep the questions coming. Really appreciate these. The questions coming through and the listener support. Absolutely love it. Thank you so much. And remember, I always ask the question, what keeps you up at night? What financial questions do you have out there that haven't been answered yet? If you heard something on the radio or you heard someone say this or that, and you want to challenge conventional wisdom and you'd like to get maybe another perspective, go to Personal Pension Radio and let me know. Thanks again for listening. We'll talk to you again real soon.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we'd appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.